أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقه قولي. So our lesson today will be about the performance analysis of Sukuk and mutual funds. Yesterday you were talking about mutual funds. We talked in detail about mutual funds, the definition of mutual funds, the importance of mutual funds, the types of mutual fund, the role of Sharia board when it comes to the management of mutual fund. So today we shall basically be talking about the following. So these are the lesson objective. So by the end of this lesson, the learner should be able to do what? Define and explain performance analysis, differentiate quantitative and qualitative methods, understand factors influencing mutual funds performance, balance risk and return in Sukuk investment, evaluate strategies to achieve an optimal balance between risk and return in Sukuk investment, assess the impact of Sharia compliance, that is, understand how adherence to Sharia principles influences the performance of Sukuk. So these are going to be our lesson objectives in this lesson. So number one is what is known as performance analysis. So we normally have in performance analysis, we normally have two things. We have performance analysis, and sometimes they call this the key performance indicators. So what are these? What are key performance indicators? So key performance indicators are measurable values that demonstrate how effectively an organization, department, or individual is achieving key business objectives. In finance and investment, key performance indicators serve as what? Benchmarks that guide decision making and help assess performance in relation to financial goals. So basically, what they're telling us here is that number one, key performance indicators are measurable values. They are quantitative in nature. And they are used to demonstrate how effectively an organization is. That is, how good an organization is in achieving its goals. You know, and in finance, these key performance indicators are very, very important. Why? Because they guide us when you're making decisions and they help us to assess performance in relation to financial goals. That is, how close or how far are we from achieving our goals? Now, what are the importance of key performance indicators? Number one, these key performance indicators, they do what? They help, number one, in decision making. So they provide quantifiable metrics that help investors and managers make informed decisions. For example, if a mutual fund's return is not meeting benchmarks, it may lead to a strategy revision. You know, the manager might be forced to seek another, or the manager might be forced to invest, or the investor might be forced to invest in another area. Performance evaluation. The key performance indicators allow for fair performance evaluation over a specific period, helping investors compare similar investment options. So these key performance indicators, they help in evaluating performance, So we can basically evaluate similar investment. There is investment A, there is investment B. So we can be in a position to know which investment is doing good and which one is doing the opposite. Goal alignment, the KPI, key performance indicators, ensure that everyone involved in the investment process is working towards the same objectives and targets. So the KPI, it helps to align our efforts. It helps the organization to work synergetically towards an objective. Then lastly, risk management. Key performance indicators help identify Areas of underperformance. What are the areas that we are not performing? What are the areas where our investment is not giving us the expected returns? Or risk exposure. It can help us to know the risk associated with each and every investment, enabling proactive measures to be taken before these issues escalate. So the key performance indicators will help us to know this problem before they worsen. Now, when you're talking about performance analysis, we normally have the quantitative and the qualitative analysis. So we want to know what is the quantitative vis-a-vis the qualitative analysis or the performance of sukuk and mutual funds. Now, number one, let us start with the quantitative analysis. So what are quantitative analysis? Quantitative analysis involves the use of mathematical and statistical model to evaluate what? Asset performance and make investment decisions. This approach focuses on numerical data and aims to identify measurable patterns and trends. So when you're talking about quantitative analysis, number one, it is numerical and it uses mathematical model to evaluate how good an investment is, and it also helps us to identify what measurable patterns and trends. Now, what are some of the methods of quantitative analysis in asset performance? So we have many. Number one, financial ratios. Number two, statistical analysis. Number three, we have the performance metrics. So let us start with the financial ratios. Ratios like price earning, debt equity, and return on equity or equity provide insights into a company's financial health. For example, if company A has a price earning of 15 and company B has a price earning ratio of 25, company A may be considered undervalued relative to its earning. Number two, statistical analysis. Techniques such as regression analysis and correlation are used to identify trends and relationship between different financial variables. For example, a regression analysis might reveal a strong correlation between a company's advertising spend and sales growth. So when we are talking about regression or correlation analysis, for example, we normally have it in research. We might be having independent variable and dependent variable. So the statistical analysis will help us to know the relationship. Is the relationship negative or is it negative or positive? For example, you might find that there is a positive relationship between a company's advertising and sales growth. The more we advertise, the more the sales. Performance metric is number three. So metrics like total return, Sharpe, ratio, and alpha help quantify investment performance and compare it to benchmarks. For example, a mutual fund with a total return of 10% and a Sharpe ratio of 1.5 may be deemed a strong performer on a risk-adjusted basis compared to another fund with a total return of 6% and Sharpe ratio of 0.5. Now, on to the next. So we are through with the quantitative analysis, which is numerical, which uses mathematical model. So let us go to the qualitative analysis. What are qualitative analysis? Qualitative analysis assesses non-numeric factors that can impact an asset performance. And when we are talking about non-numeric, we are basically saying they are not mathematical models. For example, quality of management is a qualitative metric. Brand strength is a qualitative metric. Market condition is a qualitative metric. And economic indicators. So all of these can guide us to know how well or how good our mutual fund or our sukuk, the Islamic bond, is doing in the market. Now, what is the role? What is the role of qualitative factors in performance evaluation. Number one, like we have management quality. So what are the qualitative indicators here? So evaluating the experience, track record, and vision of a company's management team can provide insight into future performance. For example, a company led by a CEO with a successful history of turning around struggling firms may be seen as a better investment, even if its current financial are mediocre. So maybe, like we can take an example for Dabshil Bank, for example. Maybe the financial, maybe financial is not doing good, but maybe if you look at the management, the higher management, the executive board, it's well experienced, their track record is good, and they're visionary. So, despite the fact that the financial metrics is not looking good, but we can rely on the management quality. Number two, market position. Understanding a company's competitive advantage and market share can help investors gauge potential growth. For example, a tech company with a unique patent that gives it a significant edge in the market may be evaluated more favorably than a competitor without such a distinction, regardless of current sales figures. So your competitive edge in the market is really a qualitative measure that investors can use to do what? To make an informed decision of whether to invest in your company or not to invest in your company. Number three, economic conditions. Factors like consumer sentiments, regulatory changes, and macroeconomic trends can have significant qualitative impacts on asset performance. For example, if a country is experiencing political instability, analysts may downgrade their evaluation of companies operating in that region, even if the companies show strong quantitative metrics. So the political instability can be a qualitative indicator that can guide us when we're making a decision of whether to or not to invest in a company. Countries that are politically stable are very different from countries that are politically countries that are not stable. Now, these are the other qualitative factors. This is what we've just talked about. Management quality. A company's experienced leadership team might inspire investors' confidence, positively impacting stock prices. Market trends and sentiment. For example, positive news about a company or sector can boost asset demand, even if financial metrics are average. Regulatory environment. Favorable government policies towards renewable energy can enhance the performance of green energy funds. Then lastly, economic and political factors. A stable political environment can attract foreign investment, improving the performance of what? The performance of local markets. What are now the other general factors that can influence the financial performance of mutual funds? What are the other general factors? Number one, market conditions. The overall state of financial markets significantly impacts mutual funds performance. For example, the key factors here, we normally have what is known as the bull and bear markets. Example, equity mutual funds. And remember, when you were talking about the equity mutual funds, these are funds that, for example, when you are investing in company A or B and you're buying shares, you are investing by buying shares in a company A or B, C. That is what is equity mutual fund. So equity mutual funds tend to perform well in bull markets as stock prices rise, whereas the bear markets may lead to losses. Interest rate change. Rising interest rate can negatively impact bond mutual funds by reducing bond prices. Fund manager expertise. The skills and strategies of the fund manager play a critical role in determining performance. So the key factors is active management skills. For example, a skilled fund manager may outperform the market by adeptly selecting undervalued stock or effectively timing market entries and exits. This expertise can lead to higher returns compared to passive investment strategies, especially in volatile or inefficient markets where skill analysis can uncover mispriced assets. Investment philosophy: a value investing manager focuses on undervalued assets, seeking stocks that are trading for less than their intrinsic value, which may yield better long-term returns compared to growth-focused funds. So under certain market conditions, this approach often emphasizes fundamental analysis and patience, allowing time for the market to recognize the true value of the investment. Number 3 is the expense ratio. And this is the cost associated with managing the fund, such as administrative fees, directly impact net returns. So low expense ratio. For example, an index fund with a 0.2% expense ratio might consistently outperform an actively managed fund with a 1.5% expense ratio. All else being equal. The lower fee mean that more of the fund's investments, the lower fees means that more of the fund's investment returns are passed on to the investor, which can significantly compound over time. Hidden costs. High turnover in what? In actively managed what? High turnover in an actively managed fund may lead to additional transaction costs, such as brokerage fee and taxes, which can reduce net returns. These hidden costs are often not reflected directly in the expense ratio, but can nonetheless diminish an investor's overall profitability. Asset allocation and diversification. The distribution of investments across asset classes and sectors affect risk and return. So, sector concentration. For example, a fund heavily invested in technology may perform well during tech booms, benefiting from rapid innovation and growth in the sector. However, it may face significant losses during downtowns in technology, as poor performance in that sector can drastically affect the fund's overall returns. Geographic exposure. A globally diversified fund can mitigate losses in one region by capturing gains in another. For instance, if a fund has investments across North Africa, Europe, and emerging markets, a downturn in one area may be offset by positive performance elsewhere, helping to stabilize overall returns. Economic and political factors. Macroeconomic condition and political events influence mutual fund performance. Key factors here include recession and booms. During economic downtowns, defensive funds, that is, for example, healthcare or utilities, may outperform growth-focused funds, as investors tend to seek stability and essential services during tough times. Policy changes. Tax incentive for specific industries can benefit sector-specific mutual funds, leading to increased performance in those areas, as favorable policies can drive growth and investment into particular sectors of the economy. Investor sentiment and behavior factors. Investor psychology can create market trends that affect fund performance. Key factors here, we have the herd mentality. A sudden rush of investors into renewable energy funds can inflate prices, benefiting existing fund holders. Market overreaction. Negative news might lead to disproportionate sell-offs, creating buying opportunities for well-managed funds. Now, the last part is evaluating Sukuk performance. That is balancing risk and return in Sukuk investments. So, number one, if we want to guarantee ourselves high returns and if you want to minimize the risk while investing in Sukuk, this is what we need to do. Number one, we need to understand the Sukuk structure. So the type of Sukuk determines the balance between risk and return. So the asset-based Sukuk provides stable return as they are backed by the creditworthiness of the issuer rather than the asset itself. So higher reliance on issuer solvency, meaning that if the issuer faces financial difficulty, the returns may be jeopardized. Another example, the asset-backed Sukuk offers lower risk since the Sukuk holders have ownership in the underlying assets, providing a tangible collateral for their investment. And what is the risk? Relatively limited in issuance compared to asset-based Sukuk, which may restrict liquidity and marketability. Creditworthiness of the what? Creditworthiness of the issuer. The financial health of the Sukuk issuer. The financial health of the Sukuk issuer significantly impacts risk level. So we have the high-grade issuers. Sukuk issued by government or blue chip corporation are generally low risk but offer modest return. Low-grade issuers. Sukuk issued by smaller or riskier entities might offer higher returns but come with increased risk default risk. Market and economic conditions. The macroeconomic factors influence the performance of Sukuk investment. So, for example, rising interest rates can make fixed return Sukuk less attractive compared to other instruments, impacting their market value. On the flip side, the economic stability, Sukuk from economics with stable growth and low inflation are considered lower risk. Diversification strategies. Diversification is all about spreading investment across multiple Sukuk, can help to reduce the overall risk. And here we have the sector diversification. Investing in Sukuk across industries such as energy, healthcare, and infrastructure minimizes sector-specific risk. While we have the geographical diversification, including Sukuk from different regions, can also help reduce the risk. Liquidity consideration is another factor. The liquidity of Sukuk affects their risk-return profile. High liquid Sukuk. Sovereign Sukuk typically have active secondary markets, offering lower risk due to easier trading. Illiquid Sukuk from the private issuers or niche markets may offer higher returns, but pose challenges in exiting positions. Sharia compliance and ethical consideration. Adhering to Sharia principle influences both risk and return. And here we have two factors, the ethical appeal. Sukuk investments avoid high-risk activities, e.g., gambling or alcohol, reducing exposure to volatile sectors. Number two, compliance oversight. Regular audits ensure adherence to Islamic principles, maintaining investor confidence and reducing reputational risk. Inflation and real return. Inflation normally erodes real returns, impacting Sukuk profitability. And here you have two factors, inflation-protected Sukuk. Certain Sukuk are structured to provide inflation-linked returns, preserving the purchasing power. Then we have the fixed-rate Sukuk. These offer predictable but potentially lower real returns during inflationary periods. Now, Sharia compliance and its impact on Sukuk performance. Like, what is the effect of complying to Sharia Like, let me rephrase it. When you're talking about Sharia compliance and its impact on Sukuk performance, that is, what is the effect on our Sukuk performance if we are complying to Sharia and if we are not complying to? What will be the impact? Will it be negative or will it be positive? So, the adherence to ethical principles. Sukuk adhere to Islamic principle, ensuring that investment are free from activities prohibited under Sharia law, such as gambling, alcohol, and interest. So what is the impact of this, of ethical adherence, ethical appeal? So it will attract socially responsible investors, creating a stable demand base and potentially reducing volatility. Sector constraints. Limited exposure to high sectors like financial derivatives ensure steadier performance. Number two, what is the impact of prohibition of riba? Sukuk returns are derived from asset performance or profit sharing rather than fixed interest payment. What is the impact of this? Returns from Ijara Sukuk, for example, the leasing contract, are tied to predictable rental incomes offering stability. Also, market sensitivity. Sukuk are less sensitive to interest rate fluctuation compared to the conventional bond, as they do not involve fixed interest payment. Transparency and accountability. Sharia compliance mandates detailed disclosure and transparent structure. So what is the impact of this? There is the investor confidence. Clear reporting on asset use and profit distribution builds trust, supporting long-term demand for sukuk. Reduce risk. The requirement for tangible underlying assets ensures that sukuk are less speculative and more secure. Regulatory oversight. Sukuk are reviewed by Sharia boards to ensure compliance, adding an additional layer of scrutiny. So, what's the impact of this? Compliance costs. Higher costs for certification and ongoing audits can reduce net returns. Market perception. Strong regulatory framework, such as those in Malaysia and the GCC, enhance investor confidence and support sukuk performance. Risk sharing and asset-backed structures. Sharia principles emphasize risk sharing rather than risk transfer, which is common in conventional debt instruments. So what's the impact of this? Reliance in market crisis. During financial crises, sukuk backed by real assets tend to perform better than unsecured bonds. Limited risk exposure. Sukuk holders share in both the profit and risk of the underlying assets, leading to aligned interests between issuers and investors. Limited speculation. Sukuk structures avoid excessive uncertainty or ambiguity in contracts. So what's the impact of this? So there is the reduced volatility, and this, for example, by avoiding speculative practices, sukuk offer more predictable performance compared to high-risk investment. And also there is the element of constrained returns. The avoidance of speculative gains can limit the upside potential in certain market conditions. Regional and global demand. Sharia compliance broadens sukuk appeal to both Islamic and ethical investors worldwide. What's the impact of this? High demand in Islamic markets. Sukuk dominate in regions like the Middle East and Southeast Asia, benefiting from consistent demand. Growing non-Islamic interest. Ethical investors in Europe and the US increasingly see sukuk as viable alternative to conventional bonds. So now that is the end of our lesson for today, and I hope you have really enjoyed it. Thank you until we meet next time.